there are two kinds of people. There are people who think that President Trump is putting undue pressure on the Fed, and there are people like President Trump and myself who think that if a Fed official committed mortgage fraud, that this should be examined, and that they shouldn't be serving as one of the nation's leading financial regulators.
Hello, everyone, and welcome to the Week Ahead on Nomura Podcasts. My name is Zubin Paracuelas, Chief Southeast Asia Economist at Nomura, and today is Friday, the 29th of August. We have yet another big week ahead with all eyes on the U.S. jobs report and ongoing headlines regarding the firing of Fed Governor Cook by President Trump, as we heard there from Secretary Bessent in a Fox interview. Ruchir Sharma from our U.S. economics team gives us a preview and discusses all the near-term implications for the Fed. In Europe, Josie Anderson from our economics team in London gives us her take on upcoming inflation data, some central bank divergence, and the potential fallout from the vote of confidence in France. In Asia, Hannah Liu from our China economics team discusses why China's growth outlook in the second half of the year remains subdued and Beijing's likely policy strategy amid a strong rally in equity markets. Finally, in a special segment in this episode, we focus on the next leg of easing by Asian central banks and market implications, with Sonal Varma, our chief economist for India and AEJ, and Albert Jung, our rate strategist. A lot to digest, so let's get going. Okay, let's kick off with the U.S., and I'm joined by Ruchir from our team in New York. Hey, Ruchir, thanks very much for joining today. It's yet another big week for the U.S.
Hey, Yuben, thanks for having me.
Yeah, the first question on the all-important jobs market report. It's out next week after the shock last month. What do you expect the NFP will be?
Yeah, so for the NFP next week, labor data released so far, it's signaling a softening labor market. And service surveys and even the Fed speak, they've highlighted that we are in a low hire, low fire kind of an environment. So claims have moved up from their historical lows, but they're still somewhat subdued and not signaling red flashes that there are no signs of widespread layoffs yet. But there are some of the concerning signals that we got. For example, Conference Board's labor differential that measures labor demand and that asks people, is job hard to find or are jobs plentiful? So that actually dropped to its lowest level since Feb 2021. So for the monthly NFP reports, we think that the job gains remain subdued and just short of 100K. So private job gains were subdued while government job gains and employment slightly rebounded. So given the huge backward revisions to the prior month in the July report, following which Trump actually fired the BLS chief, everyone would be looking at the revisions. And looking at the historical trends, we've seen that the average revisions to the July report in previous years, that's been slightly positive. Well, it's been slightly negative for June, so we'll be taking a close look at that. As for the unemployment rate, which has been time and again reiterated by the Fed as a key measure to gauge the state of labor market, we think that the unemployment rate just ticked up to 4.3%. And it's still low by historical standards. And so finally, coming to wage growth, we think that average hourly earnings growth just rounded down to 0.3%. And policymakers have actually remained sanguine about wage growth. But I think that lead indicators for that have stabilized and wage disinflation has been somewhat sluggish lately. So given a pickup in the services inflation in the July report, it would be key to monitor how wage growth progresses further.
Okay, interesting. And if your forecasts pan out, what would be the implication at the next FOMC in September?
So given how Chair Powell described balancing risks to price pressures and labor markets, I think this is going to support our call for a 25 basis point cut in September, since labor markets are in fact softening. And another important thing that actually caught some attention was a footnote in Powell's speech at the Jackson Hole, where he mentioned about the QCEW or the benchmark revisions. So in early September and right before the Fed meeting, the BLS is going to provide an early estimate of the benchmark revision. So in this process, what happens is that the BLS goes out and looks at the QCEW data, which is a comprehensive data, covers around 95% of the US employment. And then the data through March 2025 is going to be revised. So though it's going to be a backward looking data, it's definitely going to be a dovish developments. So we've seen that the data that we have as of now, it suggests, and it was also mentioned by Powell, that that's going to revise down the pace of job creations that we saw last year and early this year materially. So, but we'll also be looking at some of the forward-looking signals. For example, how was the pace of job creation in early 2025 and what industries were actually impacted by this kind of a revision. And I think that, again, this is a dovish development and the Fed would definitely pay attention to it.
Yeah, and definitely something important for markets to watch, even after next week's NFP. Last question, Ruchir, staying on the Fed. What is the latest situation with respect to Governor Cook? Is this, in your view, going to be a long, drawn-out process, and would that raise more concerns about central bank independence?
Yeah, definitely. There's been a lot of things going on about the Fed, and we saw that President Trump fired Fed Governor Lisa Cook. It's completely unprecedented, and he actually cited in his letter, and I quote, false statements or one or more mortgage agreements as a cause to remove her. And now we've seen that the administration is pressuring the Fed, but this is completely in an uncharted territory. So Cook actually litigated, and as we speak, she just filed a lawsuit to sue Trump. And as you said, this is going to take some time and this is going to be a long drawn process. And Fed issued a statement early this week which mentioned that they're going to abide by the court's decision. So we think that ultimately the Supreme Court is likely to decide whether the for-cause requirement has been met or not. But again, this has important implications for monetary policy in several ways. So if Supreme Court actually allows President Trump to fire Cook, then a new governor, along with Governor Waller, Governor Bowman, and the new nomination in place of Kugler, Stephen Miran, that would make the board dovish, and a majority of the board would be dovish, and that could actually impact the near-term monetary policy outlook in a big sense. And additionally, the Fed board has to approve the upcoming periodical reappointment of the regional Fed president. So that's due in February 2026. So if a majority of the Fed governors, they reject to reappoint some of the hawkish regional Fed presidents, it could again affect the entire composition of FOMC, and that could increase the risk of aggressive easing next year. So that's another important point to look out for. And finally, as you said, it's definitely going to impact the credibility of the Fed, and this could actually impact inflation expectations, which could further convolute their work ahead in the coming months.
Yeah, brilliant. Yeah, let's leave it there. Thanks, Ruchir.
Thanks a lot.
All right, now let's swing over to London, where Josie is joining me from. Josie, thanks again for coming into the podcast.
Yeah, thanks for having me, Eubin.
So first question on the week ahead, what are you watching in Europe? I guess there's some inflation prints coming out.
Yeah, a key data point next week will be Euro area HICP inflation, where we believe underlying momentum is slowing. We actually get some data out tomorrow, so we're recording this on Thursday. We will actually have individual country level data for Germany, France, Italy and Spain out on Friday this week that will give us more colour. But the big picture for the euro area is that we expect inflation to hover around the ECB's 2% target until year end. Some key questions we're looking at are, is service price momentum slowing gradually in line with our expectations? We think it will. And also, is there any sign of weaker than normal core goods prices owing to potential Chinese goods dumping? We don't actually expect to see that.
Okay, yeah, interesting. And then in Switzerland and Sweden, we also have some CPI numbers coming out. And yeah, if you can also give us a sense in terms of the implications on these central banks.
Yeah, thanks. So we have key meetings for the central banks in Switzerland and Sweden in September. So these inflation prints will be interesting. The stories in these two countries differ quite a lot, actually. In Switzerland, they're battling very low inflation. So we actually saw a bit of deflation earlier in the year. CPI inflation has turned positive, and we expect a low positive number in the data for August. But that would follow a slight upside surprise driven by transport and hospitality sectors in the July data. But Switzerland is interesting at the moment because, of course, it's battling very high US tariffs, which surprised most people to the upside. So that could potentially add to reasoning for a rate cut, but that rate cut would take the policy rate negative. So there's a lot of uncertainty about resistance to do that. Meanwhile, in Sweden, inflation has been surprisingly sticky, and it surprised the Riksbank, the central bank in Sweden, to the upside quite notably over the course of the summer. And we expect it to stay fairly sticky, partly because electricity prices have been rising over the summer, but also we don't necessarily expect things like air travel prices and car rental prices to come down that quickly, which means we expect some stickiness in the CPI FX energy print as well.
Okay, so yes, some interesting divergence there. And then finally, Joseph, in France, which is has been the focus for markets, I guess, in recent days, in relation to the vote of confidence. What's the latest on that, and what do you think could be the potential outcome and any fallout as a result?
Yeah, so this week, after the French government has been stuck in a deadlock over discussions surrounding proposals for the 2026 budget, the Prime Minister Bayrou had to call a vote of confidence, which is scheduled for Monday, the 8th of September. At present, we think the most likely scenario or outcome of this vote is that the Prime Minister will not win the vote of confidence and the French government will fall. And so then it falls to President Macron to make a difficult choice. He could appoint a new Prime Minister and form a caretaker government, or he could dissolve Parliament and call new elections. So therefore, we're going to see quite high levels of uncertainty in France this autumn, and drafting and passing a 2026 budget has become even harder, and possible delays to fiscal consolidation are likely going to be seen.
Right. So it seems like crucial timing for this vote. Okay, let's leave it there. Thanks, Joseph.
Thanks a lot, Euban.
Okay, now let's go to Hong Kong, and I've got with me Hannah from our China economics team. Hey, Hannah, thanks, and welcome back to the podcast.
Thanks, Euban. Always a pleasure to be here.
Cool. So first question, let's start with the week ahead. So there is the PMI data coming up. What do you expect there?
Well, as we transition from summer break to the school session, we'll be getting the August official PMI numbers this Sunday. Actually, by the time you are listening to this podcast, might be that the PMI numbers are already released. But anyway, we're expecting the manufacturing PMI to hold steady at July's low of 49.3. And the non-manufacturing PMI is likely to edge down slightly to 50 from 50.1 in July.
Okay, so still relatively weak readings, and I suppose that's supportive of the outlook for the second half of the year, still subdued, as you guys have been publishing in your recent reports, right?
Yes, correct. So the soft PMI numbers could lend further support to our broad view on economic slowdown in the second half. Let me break down into 5 key factors that we are watching. And the first one is the ongoing austerity rules imposed on those workers for the government could squeeze the catering sales. And second, we are seeing a clear payback effect from the durable goods trade-in subsidies that was enrolled in from the September of last year. And third, the anti-involution campaign, which are without good intentions, and actually it's good for the economy in the long run, but in the short run, it could cut production and dampen investment, especially in the coming months. And the fourth, export growth is set to slow down, even though the chance of a big collapse could be avoided this time around, given that US tariffs on the other countries turned out to be higher than expected. But the 6% growth rate that we witnessed in the first half probably won't continue. And finally, the property sector, of course, is still in a big trouble. The recent easing measures rolled out in major cities like Beijing and Shanghai is just like pushing on a string.
Yeah, got it. And yet you've got equity markets in China rallying in recent months despite a relatively subdued growth outlook. So, from a policymaking perspective, does that put Beijing in a little bit of a tightrope in trying to ensure that financial stability risks are managed, i.e., preventing bubbles in the equity market, and at the same time still trying to support economic growth? So, what do you expect is the policy strategy of Beijing?
Understood. Yeah, this is a great question, Ruben. As you said, policymaking at this stage is especially tricky. Beijing needs to support economic growth while trying to avoid inflating a stock market bubble at the same time. In our view, right now, the best strategy might be just to draw lessons from the past. On the one hand, we think doing nothing is not an option. Based on the lessons from 2015, we believe the stock market rally itself could not provide a boost to the real economy. And the economy will still likely to face a slowdown in the second half despite the stock market rally. But on the other hand, doing too much is also not a good strategy. As we recall, Beijing aggressively cut policy rate by 3 times and cut RRR rate by twice during the stock market boom in 2015, which clearly contributed to the stock market exuberance at that time. So this time around, we think Beijing could be less urgent to roll out any high-profile supportive measures if the rally continues. So in this regard, we currently are only expecting a 10 BP rate cut and one-time RRR cut in the fourth quarter of this year, as of now. And we believe more targeted measures could be more likely. For example, could be more fundings to clear up the property mess, and also more fiscal fundings to ease some deeply rooted problems such as the highly unequal social security system in China. Yeah, and that's our view.
Okay, fascinating. So targeted and a measured approach, it seems. Excellent. Let's leave it here. Hannah, thanks very much.
Of course.
And finally, in this special segment, we focus on Asian central banks, and I'm very delighted to be joined by Sonal Varma and Albert Leong in Hong Kong, who are the lead authors of our joint report we just published earlier this week. It's called Asia Entering the Next Leg of Policy Easing. Thank you both for joining. So, Sonal, just starting with you, what are the main reasons you think central banks are going to start resuming their cutting cycles after being on a wait and watch mode? And in particular, be interesting how much of that is being driven by the outlook on Fed policy.
Yeah, hi, Yuban. So Fed is obviously quite important for many central banks in Asia, but I would say it's not the only trigger. So central banks in Indonesia and Korea do look at Fed more closely, but I think for other central banks, we are thinking of other potential drivers. So first of all, we think the growth outlook is going to end up being weaker than expected. So what has happened so far is actually we've gotten positive surprises on the growth front because of export front loading in Q2 GDP numbers. And of course, the tariff rates are lower than the Liberation Day level. So there was some positive surprise. But our view is the full tariff impact on exports is still ahead of us. We still have the sectoral tariffs on electronics, which is a major driver of regional exports. And China, I mean, we are expecting growth in China to also slow in the second half because of the anti-austerity measures, the anti-involution campaign, and end of the consumer trade-in program. So we think growth is going to surprise lower. Second, inflation remains extremely benign across the region. In fact, when we compare our underlying inflation metrics, it's below all central bank targets in the region. So this is quite a contrast actually from rest of the world. And finally, real rates are quite restrictive. So our measures of financial conditions, our measures on Taylor rule estimates do show that rates are actually now moving into restrictive territory as central banks keep rates on hold, with inflation coming down and output gap being negative. So there is space, but there's also a need.
Yeah, interesting. And I might add, we have a few CPI numbers coming out for the month of August in the week ahead. Actually, we have Indonesia, Thailand, Korea, Philippines, and Taiwan. All of them are either flat or lower. So again, supportive of your view, except for the Philippines, which we think it might tick up a little bit, but again, coming from a very low number in the previous month and still well below target. Sonal, second question is, you also flagged some divergences nonetheless in the report. So which central banks do we have more rate cuts in our forecast relative to what's priced in and where we have relatively high conviction?
Yeah, so three central banks in particular where we think cuts will be more than what's priced in by the markets right now. That's India, Korea, and Indonesia. So for India, we are expecting the impact from US tariffs to be worse than what the RBI is expecting. So we think there'll be 50 basis point more in cuts compared to consensus expectations of 25. In both Korea and Indonesia, Fed is an important trigger for more cuts in our forecast. And in Korea in particular, the BOK appears to be, I would say, more concerned about the growth outlook next year, with their expectation that exports might actually contract next year as the tariff effect plays out. So we're expecting 50 more in Korea and 75 more in Indonesia. Now, Thailand is also potentially a candidate. I mean, our expectation of 50 basis point more is in line with what markets are pricing in. But given our view that deflation will sustain through next year, the risk we see is actually terminal rates could be below 1%, which is not our base case, not priced in by markets, but that's the direction of risk. On the other hand, there are some central banks where we think rate cuts will actually be less than what is currently priced in. So both for Taiwan and Malaysia, we are expecting central banks to be on hold and not get into an easing cycle.
Yeah, thanks, Sonal. Actually, we have BNM as well next week, and our forecast is for them to stay unchanged, keep the policy rate on hold, again, because we think they're still relatively optimistic on the growth outlook, particularly on the resilience of the domestic economy. Yeah, thanks. And now bringing in Albert, you also see a little bit of a divide in your views. I think you were noting the divergence between the North Asian markets and the South Asian markets.
Yeah, absolutely. So I think overall, right, the Fed cut and a softer US dollar should be supportive of EM local rates. But so far this year, we are actually seeing quite big divergences between the North Asia and the South Asia rates market. Like the likes of Indonesia, India, and Singapore rates have come down substantially, some by more than 100 basis points this year. And on the other hand, China and Taiwan rates are actually up on the year. So, but I think we can use some fundamental and fund flow dynamics to explain that. Like the Southeast Asia central banks generally have stronger easing bias. They have cut rates by more than the North Asia. India and Indonesia, in particular, have a much higher real yield cushion, given that the inflation has been subdued. And on bond flows as well. So we are starting to see the inflow to high yield markets picking up. But for China bonds in July, which is the latest data, the foreign outflow was actually the largest in over 2 years. So you can see the contrast there.
Okay, got it. And let's go into a little bit more specific. So you said South Asian markets could do well. They've already rallied quite a bit. Can they still outperform in that environment? Any idiosyncratic factors that you're watching closely apart from the rate cuts that could drive that outperformance?
Yeah. I think, to be honest, I think that India and Indonesia, as you mentioned, they have rallied a lot, but we still think that the bonds can continue to and the rates can continue to come a bit lower, in particular for the front end. Like so, besides the rate cut view, right, for Indonesia, we think that the positioning in Indonesia bonds are actually still quite light, probably just around neutral from our surveys, right? So our surveys are showing among the EM local rates, investors tend to be more overweight in markets like Brazil and South Africa. Probably fair enough, right? They're high yields. But I guess Indonesia is also something that, I think looks interesting because the rate cut cycle looks to be continuing. And if you look a little bit related to that, I mean, the BI has continued to optimize this monetary operation by reducing the size of the SRBI. So I think this is the supply side is also quite supportive. And on India, right? So yeah, I mean, it's partly related to the rate cut, potential rate cut, because the market is pricing a very limited rate cut, like 10 to 15 basis points over the next 12 months, and we're calling for 50. But I think so. There's a little bit of a concern on the fiscal side, but we also think that because of the tariff, but we also think that there's some room for the fiscal term premium to come down. Like there could be a few ways for the authorities to calm the bond market, like maybe the resumption of a bond buyback by the RBI, or the RBI can actually guide the liquidity or the overnight MIBOR slightly away from the repo rates down towards the middle of the policy. So I think besides the policy rate cut, there's a few things on liquidity, bond buyback, and even reducing the bond supply that can be done. Now, I think besides India and Indonesia, the third market we think can do well is actually Korea. Yeah, so I think partly on the valuation is like only 25 basis point price, roughly 25 basis point next 12 months. The market is going for 50 basis point. So next year, right, there's a WIGB bond index inclusion. It will start in April. So usually the bond flow tends to come a few months before the index inclusion. So I think it could be another factor supporting Korea rates.
Okay, yeah, that's clear. Finally, any quick thoughts on the near-term risks that you're watching in terms of your views for both of you?
Yeah, sure. Maybe I'll start first. So I think to me there are probably two main risks, right? The first one is, of course, the Fed policy, I think. So it's quite a lot priced in, so about 120 basis point over the next 12 months. I guess, of course, it can still go either way, right? Because if Trump managed to get all the doubts in, it could be we can still see very aggressive cuts for next year. But in contrast, I think it's also possible if we have one or two reasonable NFP print, inflation still stick around the current level, about 2%. I think this 120 basis point pricing can potentially go back to like 75. Like even our US economist is only calling for 75, right? Even at the start of September, only 75 basis points so far. Till the end of the next year. So if indeed we see a little bit of a price back or Fed cut, then it may potentially impact some of the Asia central bank. And I think the other risk maybe not very directly related to race, but it could still be relevant, is this global risk sentiment. Because right now things look very benign. Globally, a lot of equity markets are close to or at year high. Credit spread is very tight everywhere. But if this reverses, I think it could impact some of the more risk-sensitive bond markets that relied on foreign flows, right? Like, for instance, potentially Indonesia. So this is, I think, a risk that may be worth paying attention to in the next few months.
Okay, thanks, Sonal.
Yeah. So, obviously we are expecting more cuts. So the risk in terms of less cuts, one is, as Albert said, if Fed easing is less. Two, I think geopolitical risks. If that triggers higher oil price, it is going to worsen the trade-off for central banks here. But I think the balance of risk to our forecast is actually skewed to the terminal rates being even lower than what we have. Because you have the growth shock coming both from the tariff impact plus the China slowdown. And we have the disinflationary shock from China's exports being redirected to economies where inflation is already below target. So we think risk is actually skewed to even lower terminal rates.
Yep, really interesting. Okay, thank you both for joining today. Really interesting discussion, and I would recommend for all of our listeners to have a look at the report for more details. Thanks very much.
Thanks, Yuban.
Thanks, Yuban.
That's it for now, and thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.